Shares, bonds, debentures. These are the instruments which are used by companies or by financial institutions to raise money from public. This money is used by them to make investment in assets and to meet their working expenses. When the companies issue these instruments, they have to make sure that they meet the requirement of Companies Act and also the regulations framed by SEBI, Security and Exchange Board of India, which is regulator of capital market. So shares, bonds, debentures, they are instruments as part of capital market operations. Whenever a company wants to issue shares, bonds or debentures, they have to give an offer to the investors, and this offer is given in the form of a document called prospectus. So prospectus is a document of offer which is prepared by the companies whenever they want to go for issue of shares, debentures, bonds. Now we shall take up these instruments one by one. First of all, shares. So shares are the instruments which provide rights of ownership to the investors in a company. And these investors are called shareholders. So when shares are allotted to the investors, they become shareholders. The shareholders jointly own a company. So ownership of a company is normally joint by all shareholders unless it is a one-member company. So if it is one-member company, in that case the ownership is not joint, but in other cases the ownership of the company is jointly held by shareholders. Shareholders are the people who own the company and they take decisions about activities and working of the company through their voting rights. If there is a profit and company want to distribute profit, the shareholders get income in the form of dividend. Debentures. So debentures are not the instruments which provide ownership. So debentures are the instruments through which the company borrows money from the market. And these investors, these lenders may be public, institutions, banks, etc., who purchase these debenture certificates. On a debenture, the company makes payment of fixed interest periodically to the debenture holders. The debentures can be transferred like shares from one person to another according to terms of the issue. The debentures are normally unsecured. As regards bonds, bonds are also the instruments of borrowing which are used specifically by the government or by the company or institutions to borrow money. On bonds, the issuer company makes payment of fixed interest to the bondholders periodically. The bonds can be transferred like debentures, like shares, from one person to another according to terms of their issue. The bonds issued by companies are generally secured by way of charge on the assets of the company. So after giving brief of these three instruments, now we shall make comparison between these instruments. So let us compare these instruments. So here we have the shares, here we have the debentures, here we have the bonds. So first, relationship with the company. Shareholders are owners of the company. Debenture holders, they are creditors of the company or lenders of the company. Similarly, bondholders, They are creditors to the company or lenders of the company. So they have given loan to the company. Now from security point of view, security for repayment. In case of shares, there is no security. In case of debentures, these are generally unsecured. In case of bonds, generally these are secured by assets of the company. Now priority in payment in case of winding up of the company. In case the company is to be liquidated, in that case the shareholders get their money after payment to debenture holders and bond holders. As regard debenture holders, they get priority over shareholders. And as regards bond, so bond holders also get priority over shareholders, but if bonds are secured, then they get priority over debentures also. Now from income point of view, the shareholders get dividend income. Debenture holders, they get periodical interest payments. So dividend is paid only if there is profit, but interest has to be paid whether there is a profit or not. So similarly, bond holders also get interest. Now taxation aspect. Dividend is not considered expenditure of the company. Hence the company has to pay corporate tax. So they do not get any exemption. But as regards interest, interest is a payment. It is considered an expenditure of the company. Hence it is deductible expenditure before tax is paid. So in bondholder case also, interest payment is deductible as expenditure for taxation purposes. So from taxation point of view, bonds and debentures, they are better for a company compared to shares. Thank you friends for watching this video. I hope you have been benefited by this lecture. Thank you once again.